The paradox of passive income. Passive income has become the holy grail of financial independence. We've all seen the headlines promising, "Make money while you sleep," and Instagram influencers working from exotic beaches. But there's a paradox at the heart of this narrative that nobody wants to discuss. Truly passive income isn't passive at all. The biggest misconception about passive income is that it's effortless. Once you set it up, money flows with little to no involvement. In reality, most passive income streams require significant upfront work, ongoing management, or reinvestment. And here's the twist. That's actually a good thing. The myth of set it and forget it. Take rental real estate, often pitched as the classic passive income stream. In practice, it requires active involvement. Finding and vetting tenants, handling maintenance issues, managing property taxes and insurance, and navigating vacancies or legal matters. Even with a property manager, you still have to oversee finances, make decisions, and deal with unexpected problems. It only becomes semi-passive once reliable systems and people are in place, and even then, it's never truly hands-off. This pattern applies to virtually all wealth-building strategies. Whether you're building a business, writing a book, creating a course, or investing in real estate, there's always an active phase where you're laying the groundwork, developing the asset, building systems, or acquiring knowledge. Over time, as you refine those systems and introduce leverage through automation, outsourcing, or recurring revenue models, the income becomes more predictable and less tied to your direct effort. But here's what most passive income gurus won't tell you. The transition itself is where the real value lies. That journey from active to semi-passive is where skill development, resilience, and strategic thinking are forged. It teaches you how to build something sustainable, not just profitable, which separates short-term income hacks from long-term wealth creation. Why we're obsessed with effortless wealth. Our culture has become fixated on effortless passive income because it taps into a powerful emotional desire. Freedom without sacrifice. It's an appealing narrative in a world where burnout is common and time feels scarce. Social media amplifies this by showcasing curated success stories. People lounging on beaches claiming they make money in their sleep, without showing the years of work, failure, and learning it took to get there. Add to that the explosion of online gurus selling shortcuts and set it and forget it systems. It reinforces the idea that wealth should be easy if you follow the right formula. It's a seductive illusion that sells well. Still, it distorts the reality that most sustainable income is built, not stumbled into. The builder's mentality. The key difference between those building sustainable income streams and those chasing the illusion of effortless wealth lies in mindset and execution. Successful wealth builders approach income with a builder's mentality. They're patient, willing to delay gratification, and focused on long-term value over short-term gains. They see income as something to engineer, not wish into existence. They also develop practical skills like strategic thinking, problem-solving, marketing, and systems design because they understand that passive income doesn't emerge from thin air. It's the result of leveraged effort applied consistently. In contrast, those chasing effortless wealth often bounce from one trend to the next, avoiding the discipline and discomfort that real progress requires. They're looking for a result, not a process, and that's the biggest difference. The power of leverage. Effective leverage means getting disproportionately greater results from the same or even less input by applying your effort through scalable systems, assets, or relationships. In practice, this could mean creating a digital course once and selling it repeatedly instead of trading hours for coaching. It might mean hiring a virtual assistant to handle admin tasks so you can focus on high-value strategy. It could mean writing content that drives traffic for months instead of chasing daily leads. Leveraging knowledge might involve turning your expertise into a book, software, or training program. Leveraging capital could involve investing in cash-flowing assets like dividend stocks or real estate. Leveraging relationships could mean building partnerships that open doors to new markets or opportunities. The common thread is this: instead of working harder, you build or acquire systems that keep working even when you're not. But those systems still need your oversight and strategic direction. The psychological barriers. One of the biggest psychological barriers to building leveraged income is identity attachment. People are often deeply tied to the idea that value equals effort, especially if they've been rewarded for hard work and showing up their whole lives. Shifting to leveraged income feels uncomfortable because it requires stepping back, delegating, or creating something that earns repeatedly. It can feel undeserved or even lazy to someone used to grinding. There's also fear of failure and uncertainty. Building leveraged systems often means venturing into unfamiliar territory, where outcomes aren't immediate. That lack of short-term feedback can trigger doubt or make people abandon the process too soon. Another major block is control. Many people are afraid to trust systems, technology, or other people with critical parts of their business or income flow. They stay stuck in active income because it feels safer and more predictable, even if it limits growth. Ultimately, it's not just about learning new skills. It's about rewiring beliefs around value, time, and risk. The shift requires a different kind of confidence, one rooted in vision, patience, and the ability to let go of constant busyness in favor of strategic creation. Practical steps to shift your mindset. The first step is redefining productivity. Instead of measuring progress by how busy you are, start measuring it by the systems you build, the assets you create, and the problems you no longer have to solve twice. This mental shift lays the foundation for leveraged thinking. Next, start small with delegation or automation. Hand off one task you usually control, like scheduling or email filtering, and notice that the world doesn't fall apart. Building trust in systems happens incrementally, and small wins build confidence. Then, choose one area where your knowledge can become an asset, not just a service. For example, you could package your expertise into a downloadable guide, a short course, or even a webinar. The goal is to experience what it feels like to create once and deliver many times. Also, surround yourself with others already operating this way: mentors, peers, or online communities. Mindset shifts happen faster when you're close to people who've already normalized leveraged income. Finally, schedule time for strategic thinking. If you're always in task mode, you'll miss out on higher-level insight. 1 hour a week devoted to planning, systemizing, or asset creation can transform your trajectory over time. The key is consistency over intensity. The active work behind financial investments. In financial investments, passive income often manifests as dividend stocks, rental real estate, or REITs. But even these require upfront active decision-making and ongoing strategic oversight. For example, building a dividend portfolio isn't just about buying high-yield stocks. It involves researching companies, evaluating balance sheets, understanding payout ratios, and regularly reviewing holdings to manage risk and adjust for economic shifts. You're actively designing the portfolio to serve your income goals, not just hoping it works out. With real estate, you have to evaluate properties, secure financing, negotiate terms, and understand local markets. Even if you hire a property manager, you still actively manage cash flow, taxes, and long-term value creation. Due diligence is critical in private placements or alternative investments. It involves understanding the business model, exit strategy, and potential risks. Investors who skip this active phase often fall for hype or overpromise. Even in passive investing, success depends on active intention, education, and oversight. Passive income flows from clever positioning, not blind participation. The coordination game. When income streams and investments operate in isolation, you risk inefficiencies, tax surprises, and missed opportunities. Without coordination, one strategy might unknowingly undermine another, like generating high taxable income from a rental property, while simultaneously investing in a tax-sensitive retirement account without considering the broader impact. Coordinated strategy means aligning each income stream, asset, and investment vehicle with your overall financial goals: cash flow, liquidity, tax planning, and long-term wealth preservation. It ensures you're not just building income, but integrated wealth. For example, combining business income with real estate depreciation, or using dividend income to fund insurance strategies or charitable vehicles can dramatically improve lifestyle and legacy outcomes. It also reduces redundancy and stress because you work from a single unified plan instead of juggling disconnected ideas. Ultimately, coordination transforms a random collection of efforts into a scalable wealth engine. It's the difference between playing checkers and playing chess. Handling setbacks. Successful wealth builders treat setbacks as part of the process, not as a signal to quit. They expect friction and see problems as data. They analyze what went wrong, adjust quickly, and apply those lessons to improve the system. Their mindset is rooted in ownership. They assume responsibility, not blame, if something breaks. In contrast, those who struggle often interpret setbacks emotionally. A course that doesn't sell or a rental with tenant issues feels like proof that this doesn't work, or I'm not cut out for this. That mindset leads to retreat, pivoting too early, or chasing the next shiny opportunity instead of refining what's already in motion. The key difference is that successful builders stay anchored in iteration. They refine, optimize, and keep going. It's not about avoiding failure, it's about using it to strengthen the foundation. The future of passive income. The relationship between active work and passive income is evolving rapidly. Tools like automation and AI are lowering the barrier to entry for creating leveraged income, making it easier than ever to scale content, manage operations, or analyze investments. But they also raise the bar for quality and strategy. Just because you can automate something doesn't mean it will produce meaningful results. The real opportunity lies in combining human insight with scalable tools, using AI to enhance delivery or efficiency, but still applying active strategy, personalization, and judgment where it matters. That blend of leveraged tech and thoughtful execution will generate future-proof income streams. On the challenge side, the ease of entry creates more noise. It's no longer enough to have a course or write a blog. The market rewards depth, uniqueness, and genuine value. So while the tools are better, the demands for quality and differentiation are higher. The future belongs to those who understand that passive income isn't a shortcut. It's a strategic build. Builders who learn to use new tools wisely will unlock incredible leverage in the years to come. So embrace the paradox. The best passive income requires active work. And that's not just okay, it's exactly as it should be.